Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, June 10th, 2022. This is video number 2 of the day. It is 10:06 a.m. Eastern Time, and I'm going to do a video focused solely on the energy sector. Previous video, I briefly touched on crude oil and natural gas. That was along with the equity markets. You guys know my thoughts there. Whereas a few weeks ago, I told you I was pushing the equity longs hard and not so hard anymore. Do have a position, but it's not nearly what it was. As I said this morning, that just the risk reward. We already had the initial bounce off those targets. That's where the juice is. That's where the risk reward was most clear. The fact we already had it, I still think that was a first leg of probably a zigzag up. This is probably corrective wave, one more wave up. Maybe, maybe not. Doesn't matter. We're not far off the lows. So, if you want to be long the index is fine. That's just me. It's also a function of, what I'm seeing in the charts now. They haven't been as clear lately. And of course, me being out of town this week. But what I am pushing pretty hard and added to those today, mentioned starting just last week, starting to take shorts in the coal stocks. That's what I'm going to go over today. Crude oil, natural gas, and coal. They're all intertwined. They're all energy sources. Power plants burn. A combination of all, to the best of my knowledge. I know natural gas, some plants burn, they burn coal. It's their energy source. It doesn't matter whether it's a power plant or any other use. And so that has been one of the primary drivers of inflation. It's a big component. Energy is a big component of the CPI. I'm sorry, the Consumer Price Index. And Edward. So I already went over the long-term charts. Let me just do that in case you didn't watch that video, just real quick here. Well, just look at the ETFs for now. USO. USO does a good job of tracking crude. And so what you're seeing here, for the first time in some while, big negative divergence forming. And I always say divergence is not in itself a sell signal, but what you're looking at, you get extremely overbought and then less overbought. That gives you the negative divergence as a signature of a top. You have the PPO rolling over. If you look very closely, it's turned down now. The orange line, PPO line, this is your signal line. The PPO line acts faster. It's now turned down. And if it continues lower, which I suspect, I'll tell you what will most likely cause that to happen, then you get a bearish crossover, and then that divergence is what I call confirmed. And I like it when you have two distinct peaks right there. That's clean divergence. So anywho, it's a setup like anything else. It's either going to work or not work like any other trade, so don't put all your eggs in one basket. You know the drill. And again, I covered it earlier, but you have this minor uptrend line right here. There you go. And it's cracked now. So that's a sell signal. In fact, I got one out to you today on crude futures. We'll look at that because this is the real deal right here. This is what I like to trade in addition to the other things I mentioned. So we had a trend line there and it was broken, gave us a little pullback there. But what happened is we started at this point. Really, we've actually been diverging, I should add, right there on the PPO since that point. But we started getting RSI divergence because that was a peak in the RSI from right here. So what this is, that line I just drew, the divergence line in this, your uptrend line, that is a bearish rising wedge pattern, one of my favorites. And so you look real closely what happened. That wedge pattern broke down recently, hit this what I would have called BOD or benefit of the doubt support level. I'm not sure if I covered it in the last update last week or not. 120.23ish right there. It was a major reaction high. Before that correction, we tried to get it again, pulled back, got rejected, tested, test, pop, breakout, right? And now this is a failed breakout, aka bear trap. Love to see those. So you have a confluence of technical events that have occurred here just today or in the last couple of days. The breakdown of the wedge, a bounce off that 120.23 level to again validate it. So validation. All these reactions. Breakout is another validation. Backtest is a validation. So that helps. What I'm getting at, the more check marks I can give, the more reactions on a trend line, the more valid it is. Therefore, when it breaks, or in this case not a trend line but a horizontal support level, when it breaks, all the better. That's where the more I see it, the way I view technical analysis, the more check marks. The reason I give that trend line more validity is it's more obvious to others. Sometimes, I see what's a potential trend line. That's why I always say I need at least 3 distinct reactions to validate a trend line. Any 2 points can be connected at random, and then the more levels you have, the more likely it is that other traders are seeing it and going to act on that. So, hey, anything's possible. I keep using the word resilient for crude oil and natural gas. They keep, have these little breakdowns, and we don't go anywhere. But again, what's changing now is those divergences on the daily and even weekly charts are growing bigger and bigger and bigger. And the Fed has their rifles, guns out, bazookas with the crosshair set on inflation, and you can bet your bottom dollar the federal government has. There's been cries, not just in the U.S., Europe as well, all the windfall taxes and all these other shenanigans. Oil companies are public enemy number one right now. We all know that. And if you work for an oil company, look, I get it. It's just natural market forces. But when prices are high, they're evil. And that's pretty much a double top high right there as well. So we'll extend that divergence line right there. So I'm doing this. Let's just drag it, not the whole line. There it is, little extension. There you go. All right, that's it. Let's not read too much more into it. It's a breakdown. It's impulsive. It's a failure at that level. It's a back test, a breakdown and back test of the trend line with an an impulsive rejection. Everything I want to see. Enough check marks that, hey, if it doesn't play out, I don't care. I'll take this shot over and over again. And if I take this trade 100 times out of 90 times out of 100, it's going to be successful. So I gave you my targets, and it's T1, likely reaction around that level. You could move that line up a little bit. There's that reaction low. You can raise that line up to about 117. But I told you my preferred target zone. When I say preferred target zone, here's what I mean. It means I probably will not cover and try to game a bounce, as I often do. That's why I give you arrow breaks. I don't always draw the up, but an arrow break is at each target you're likely to get a reaction. That reaction may come in the form of consolidation or a bounce. But in this case, we may go right on through there, and then T2 zone's a pretty decent, again, probably get a reaction there. And then this one's even better. You have this major high right here, and it's more of a zone because it's two support levels in close proximity. Then you had the top of it there. There's the bottom, bottom, bottom. And then you back tested the top right there, bottom, bottom. And so that's it. So and that runs, as I already told you in the post, about 112.84 down to about 111.73. Potential for T4. And if it starts to play out, again, it may just be another continuation of the same. But if not, if it starts to play out, then I'll turn my focus to the daily and weekly charts and may likely extend these targets. I'm going to keep looking for potential tops, tradable tops. I could care less if it's the top in crude. I'm not out there for glory calls. I'm calling a temporary top that could morph into a longer term top. Doesn't matter, really. I'm going to trade it as it comes, and if it doesn't work out, you can set a stop. If you took it on the breakdown or anywhere along here, or you've been in it for a while. I've been highlighting crude here, all these levels. Set your stop accordingly to your entry cost, your average price, or whatever it is, and of course relative to the target or targets that you're swinging at. Some people like to take a full position and then take partial profits along the way at each target. Some like to write it down. There's a million and one ways to trade. All right, so that's it. That's how it looks near term and on the 60-minute chart. And then UNG is the ETN for natural gas, and I've already covered that in the last video as well. Series of divergent highs, need to break this level 27.54. Still think we've got a big drop coming in natural gas. You have my targets here along the way where you probably have reactions. And then to look at it on the 60-minute chart, this is a 60-minute chart, 2 months price history. And you keep getting these divergent highs like this. Here, let me color it up here. Let me use the blue color. And right here. Divergent high, nice clean trend line. These are short on a little bear flagging action, another drop, then divergent low. Watch, rinse, repeat. You're short on the divergent highs, especially on breaks of support, and then cover on divergent lows. There was a divergent low right there, and you get the up, and there's a divergent high. So we've been make no mistake about it, natural gas is still in an uptrend. These are a series of higher highs. So far, we have pretty much, well, we had higher lows until this one right here, and we had higher highs until this one right here. So this one, and if I zoom out to a longer term chart, longer term time frame, and you can even see it on the 60-minute chart, these divergences, as I showed you a minute ago on UNG, have been building. So this is a 60-minute chart, really the realm of the active trader. One of my favorites for timing entries and exits, but the bigger picture is painted by the daily and even weekly charts. So any one of these seemingly innocuous little small 60-minute divergent highs, which so far have just been pullbacks for longs to reload up on, it may prove to be the one that it finally puts the nail in the coffin for natural gas, if you understand what I'm saying. Because again, it's a cumulative effect of larger divergences that show through on the longer term time frames. And then narrowing down to the very short term, you do have, like I said, so far that was our previous reaction high, and we had all these reaction lows, and you can even see it there in the little trend line, but then we took that one out. And we did have positive divergence there when that low happened, so we got to bounce off it. But then I'm going to draw it for you here. Actually, let me add it on my chart. That right there, that little divergent high was all it took. Little divergent high, just like this little divergent low right here. Right? So that's it. Obviously, if you take it, assuming you're in it or you plan to take it, you can use a stop above the recent high, but the thing about that is every new high is an incremental marginal new high. So right now you've got pretty good support. You had support, I should say, right here at 90. That's 920, 9.20 right there. So that's a little bit above that, maybe above that upper one, 930 could be a stop level for you if you want a tight stop. Or just scale and keep it light. Natural gas is very volatile. The key to swing or trend trading this, the potential on a swing or trend trade, because I've covered this one many times on the long-term chart. Oops, that's not the one I wanted. Well, I can give it to you here. That's a 2-hour candlestick chart. Here's the bigger picture. You have a trend line, a primary trend line down here, and big support. I'm still targeting this 653, 652-ish level, which still has a potential from where we're at today. If hit, that's about a 25, about 25% drop. If that trend line hits, it's going to be about a 32% drop from where we're at. Its divergences have only been extended since then. And so therefore, if you want to try to swing down and make that 25 to 30% plus, depending if you were up or higher, you're not going to get there running a 2-3% stop. It's the nature of this beast. They're going to take your not shares, your contracts from you. Now you can use UNG. I'm talking about futures. UNG or just buy KOLD. That's the 2-time inverse natural gas short ETN. If you want to buy that, you're going to have a little decay there because of the volatility in natural gas. But if you don't have any other way to short, that's your option. If you can't short UNG or you don't have access to futures. And they do have smaller contracts. I think it's QG is the mini contract for natural gas futures. And so again, if you look, even when you're long, these little zigs and zags along the way, that's the nature. It's a volatile instrument. So what I do and what you need to do, in my opinion, is whatever your number is. Everybody's different. Someone might want to trade $2,000. Someone might have $200,000 in natural gas. So whatever your number is, it should be a lot lower than trading Amazon or even SPY or QQQ, because you're swinging for a bigger potential target, bigger gain potential, 25-30% in this case. And therefore, you can allow yourself a wider stop. And if you do, you're going to be more successful in holding those shares all the way down. Now, of course, be cognizant of the areas that you're likely to have counter trend rallies. So you can lighten up, widen your stop, prepare for that. etc. So hopefully that helps. Again, there's no set number that I can give you that is the right stop for you. Stops are very, very much a personal preference. Some people have a wider risk tolerance. And again, the stop allowance, don't get tied up with that percentage thing. It's all about dollars. I could care less on any trade how much I make or lose in percentage terms. I care about dollar terms. So if I'm trading, penny stock, or I'm flipping the pot stocks, I'm looking for a 50% run in them. I'm not going to have nearly as much money. So if I'm targeting 50% gain, I might allow 15% stop loss. But to me, it matters how much in dollars I lose. So again, that's relative to your position size, coupled with the percentage gain or loss that you're looking for on that trade. Percentage loss you're willing to take, and that should be relative to the percentage gain that you're targeting. Risk reward ratio, RR. Try to shoot for at least an RR of 3 to 1 or better. That's usually what I, as a general rule, what I go for. All right, I don't think I can add much more to that. Again, it's resilient, it's in an uptrend, it's a counter trend trade, but then again, so was shorting the equity markets, which we did starting back in November on QQQ and throughout as it was topping. And I mentioned all along it was a counter trend trade, but it looked like the right trade to be in. So I could care less whether, in fact, most of my trades are counter trend trades. All right, let's look at the energy sector. To be right on crude oil is to be right, or to be right or wrong on crude is to be right or wrong on the energy sector. So I laid out XLE. That's big energy. That's what I would consider, for lack of a better word, your most conservative energy sector ETF. I've given you the others. There's some others that have more juice. They're just higher beta to the sector due to the type of stocks they own. This is big energy, the big integrated oil producers, mainly made up of Exxon and ExxonMobil, the top holding. And so you want to verify that that's breaking down, which it is today, and that's why I'm doing this video. And I just did one a week or so ago for you, but now we have breakdowns. I highlighted some bearish developments in the sector. Chevron Corp is number 2. Highlighted, where did it go? That was the 531 bearish engulfing candle. Look at that. They made a slight clip above it, but that's not the be all end all. It doesn't mean, again, you're talking, actually we never even closed above the high of it. We basically tested the high of that candle, but again, it doesn't matter. You can see look at these divergences, big divergences like that. And let me remind you, we are in a bear market. These are equities. These are corporations. Yes, they are beneficiaries of the oil surge in oil prices, undoubtedly, no doubt. That's been a windfall to them. But I've never in my life seen a bear market, even those that preceded me trading, those that I've studied, where eventually all the ships don't go down, all the sectors are going to go down. In energy, you have more meat on the bone on this trade than you do, in my opinion, at least at this point in time, on shorting the broad market. This is one of my favorite sectors right now. I would, after today, going forward, I will be, and we're going to overweight this sector. A little work to be done, such as this trend line being taken out. But again, let's just focus on the sector ETFs, and I can get to coal, so it's not a super long video. There's XLE. That's what I was looking for. Recently, this minor trend line broke yesterday, closed below it. The minor trend line right here. There's a more significant trend line below it. That's a solid breakdown right now. So there it is. PPO poised to make a bearish high, what I call a high level bearish crossover. It doesn't matter when they cross low level down here. I look for these high level bearish crossovers. And when you do, that's usually when you get some correction. That was quite a bit. That was weeks of sideways to down action there, correction there. But this time around, these were just plain old bearish PPO crossovers. There was no divergence. What we have now, this PPO crossover is going to confirm these big negative divergences that have been building. T1 was already hit back here. T2 remains here, 66.65. I've laid this out as a trade idea for weeks now. T3 zone, which I believe we're going to, is down there about 57 to 59, 59.50. That's going to give you, if hit, a drop of about 30-35%. So plenty of meat on that bone, in my opinion. XOP, give you a little more juice. This is the oil and gas exploration and production ETF. So you do have ExxonMobil and chevron in there as well. But look at that, nice, beautiful. Broke down yesterday, was your sell confirming your breakdown candle, follow through today, and just a lot of thin air down below. This is where I'm going to give you an initial target for you if anybody wants to take quick profits. Probably come in there down to about that reaction high there. We'll call it about 140. 145 to 147.50, but we're going to probably continue on to at least, let me color up this trend line so it stands out. At minimum we'll probably come in there, that purple trend line, and measure it out for you. That's going to be a drop of, depending on if and when we get there, should be a drop of about 20%, close to it in the sector. The divergence line I had before, I just have to tweak it a little bit, and looks like we did not make a higher high. So we did make a slightly higher high in the RSI, but again, this is not this. The XLE is the main energy sector ETF, and so you don't always get perfect divergences everywhere. XES, that one, equal. Look at that, beautiful. Since the last update, pretty much an equal high. That is continues the negative divergence, expands it even larger because the indicators made again lower highs. And I always say you get the most bang for your buck. They go in that order: XLE, XOP, XES. What I mean by that, with a few exceptions, but rare exceptions, these are higher beta. So if you want to short an ETF, if you're either going to be right or wrong. You short XLE, you might make 10%. You short XOP, you might make, and I'm just picking rough numbers, you might make 13, 14%, 15 maybe. You short XES, you're probably going to get 17, 18, maybe even 20%. It goes up and down more, and as you can see, that's what it's doing. Just in the last 3 days, it's dropped to today's low about 9%. And again, I'm doing this video because it's timely. This is a breakdown. The train has not left the station. Broke down yesterday, and we have follow-through candles today. You've got a little, reaction high. I wouldn't even begin to think to come. In fact, it's still an objective short entry here. Minimum and first target 69.40, and then 63.33. That's a pretty good level there. If you get that, you're probably going to bounce. Probably bounce on the first one as well. But to give you an idea from where we're at right now, about 12 and then 17% to that level. Certainly the potential for more based on those divergences. But again, it'll all depend on what Crude's doing. This was a year-long basing pattern, powerful stuff. Look at that, just like I talked about on a much smaller scale in QQQ recently, and we got that downside break on the Qs. Oh, we have an upside breakout here, and that's bullish unless it fails. So the takeaway is, here's the post breakout. We've already successfully back tested the breakout right there and there. So what's going to be very bearish is if we fall back into the range, because once that happens, you're usually going to hit at least the midpoint there, about 55.11, and then ultimately go back down to the bottom. That's my experience. When you break out above one of those big sideways trading ranges, if you get well within it, so pretty much take out that recent low, again, that's going to probably take you down to the bottom of that. And the fact that the stock market is in a bear market and the economy is most likely in the early stages of recession, yeah, there's going to be demand destruction in crude sooner or later. And if that doesn't happen, the government's going to pull out all stops, especially with the midterms coming up and all that, to cool the runaway oil prices. All right, let's just wrap it up with coal. That'll be quick because I did a video, the last video, the only changes I've had to last video, and you can just check that on the site. It was a week or so ago. I had coaled down the list and gave you my favorite holdings. I added one more today, so I'm just going to reiterate those, and in no particular order. Here they are: Arch Coal, Megaphone Pattern, right here, Divergent High, of course, and minimum target right there is an uptrend line. So it gives you a lot of meat. You're going to have more meat on the bone on coal stocks, in my opinion, than you will in the oil and gas stocks. That's about a 20% drop from where we're at. This one was already laid out as a short trade idea there. So maybe you do better than 20. HNRG is the only one I've added that was not in the last update I did, I think a week or so ago, where I gave you my top picks. I've added this one now because it just put in a ever so slightly marginal new high. If you look really close, you can see it just barely popped that other one. And in doing so, it extended the divergences that were already in place at this previous high. And really no sell signal, more of just a kind of, hey, if oil breaks down, and especially if natural gas starts going down, it's going to put pressure on the coal stocks. They are, they are energy stocks. They're just not oil and gas, but they, it's a competing energy source. So there's your uptrend line. There's a long-term downtrend line. There's price support around $4. Um, AMR just broke down today. This one I have not touched. The only chart I touched and updated was that the one I just covered, HNRG. ANR, AMR, I'm sorry, Alpha. That just broke down today. So there's your sell signal, objective short entry, and minimum target, the yellow, larger primary uptrend line right there. And to try to give you an idea, if hit, that's going to be about a 22% drop. Way I think this one will probably play out, depending on what oil and gas does, and coal, of course. Have a reaction off that trend line, ultimately break it and come on down here to $72. And if so, you just rode out the counter trend bounces and didn't gain anything off that level. You're talking about a 54% drop in that stock. So I think that put a few pennies in your pocket if I'm right. Nice negative divergence as well there. CEIX, again, I'm just checking the boxes here. Breakdown yesterday, follow through candle today. That is an objective short entry. Nowhere close to my first target of $36. That's about 31% drop. So there's a common theme, guys. I'm looking about a 30% drop in the sector from here. It's going to help to see crude oil and natural gas. And of course, these guys first and foremost go on to break, those that haven't broken down. So let me just rifle through the rest of them real quick. BTU, I mentioned this one last week in the last video. Let's take a shot here. You have a potential left shoulder of this head and shoulders topping pattern as your left shoulder, potential head. Right shoulder here went a hair above the left shoulder, but that's fine. So far we're coming down, and this would be your neckline. So you can take a shot here, or if you did last week, at partial position at the top of the right shoulder. And what you want to see ideally, these head and shoulder patterns are easily recognized by a lot of investors, traders, because they stand out. But what most people don't do is confirm them with volume. You want increased volume on the move down that forms the head, which you did have. I can see it down there. I don't know if you can see it in the video. And then you also want to see increased volume on the formation off the right shoulder. So we'll be looking for this in the coming days to weeks. If you get that, that's going to give you a check mark, and then you have a fully formed head and shoulders pattern. Right now it's only a potential head and shoulders. And then the breakdown of below $19 will be your all in on that position. Where you take a full position. That's your sell signal. The pattern, there's your measured target, take you down there. Although I have support, my target would be a little lower than the measured target, down around 1950. But I do have a first stop around 1417. I think the buyers are going to step in and buy that level if and when hit. So let's just say you swing it down to that level, you're talking about 45%. Even if you swing it down to the neckline, where you'll probably get at least one more action, you're talking 27%. So there it again, we're going right to my 30% number, where if that's where it looks like the initial leg down in the coal stocks, if I'm right, give or take, close to 30% from where we're at right now. METC, this one you had a nice long-term uptrend line. You can see it here coming from the left. You broke down, you hit this support level 1324, and we've been ping-ponging between 1324 support and back testing the trend line from below. We recently got rejected, so if you can short it because we got rejected off the trend line, and then your next objective entry, or where you might want to add to a position, would be on a break of 1324. Targets 1090, 965, and if things get ugly, there's a big old thin zone right between here and here. That's thin zone on the volume price histogram. And 621 is a potential longer term target. We're not going to get there straight away. It'd be a 62% drop in the stock from where we're at now. But again, it's all here. It's priced into the charts that we're going to have at least that 30+% pullback that I'm looking for. NRP just starting to break down. Nothing impulsive yet. Not ideal. I'm going to tweak that trend line, which I just did, tighten it up a little. right there. I mean, take out today's lows, and you'll probably start to see the selling come into this one. So, set a price alert and below today's lows. That should do the trick. The divergence has been building. The rest of the stocks, most of them have already broken down. If this one breaks down, it's just an additional check mark, an additional reason to be short. It just increases the odds that the breakdown in the sector, and these short trades will pan out. Otherwise, sometimes some of the stocks break out in a sector, the rest hold support, and the trend continues. That's how it works. ARLP broke down yesterday above that, below the downtrend line, and followed through today. So that one is objective right now. First target being the blue uptrend line, about 12% drop. Next target, I'm going to give you one more now because I do see some support around there and a gap. So about almost $16, just under. And that's, yep, there it is, right on my 20% number. So that's the current focus target or preferred swing target, about $16 there. So that's 15.94. Remember, always cover a little bit above the actual support level. CNX, bearish engulfing candlestick, as I pointed out. I guess that was the last video or whenever I covered it, May 31st. Right there. We went up from there. And so really that doesn't come into play. That's no longer a topping stick because that wasn't the top. It doesn't matter. You still have negative divergence. And potential trend line come into play here. And again, it's going to fall with the rest of the sector if I'm correct. So this one doesn't have any hard or clear sell signals on it yet, but these divergences are pretty clear. And again, it's all about the rest of the energy sector, the oil and gas stocks, crude oil, natural gas themselves. You can track coal prices. I don't have it on a chart. You have to go to some quirky sites that track the price of coal, but I can tell you it's going to give or take fall in line with the oil and gas. Suncoke SXC. That one was your first sell signal here. The breakdown below the bearish rising wedge. And then sell signal number 2, as I believe I would have covered in the last video, would be a break, or was going to be, and then it did break down below this minor trend line or price channel. So there was your second sell signal, and now your third you just took out, or we're starting to take out the 755 support level. 647 next target on that. And the last, nope, I have two more that I had checked. NC, beautiful little bearish rising wedge pattern. I mean, how can you not like this? This is one I mentioned taken personally last week, I think it was, on that breakdown there, and boom. So since the breakdown, almost all red sticks. We had one day of consolidation, one slight green stick. It's already down over 13% since the breakdown there. There was our little consolidation. And it's so far, it's really, do not do not pass go, do not collect $200, whatever, go straight to jail. It's going straight through that first target, or the price, target I had, 51.23. It's already taken that out. And this will be, especially if we can get some traction on the crude shorts and natural gas shorts, you're going to get a crowded rush for the exits. This is a crowded trade, and I love being long crowded trades, crowded short trades when there's a squeeze, and I love being short, crowded, bullish trade, long trades, especially on these guys. These are relatively thinly traded stocks. So when you have institutions and a lot of individual investors trying to get out and realizing that they stayed too late to the party, oof, can be nice. That would be down here is what I'm looking at. There it is, 22%. That's, again, I don't expect much, if any. I have no intentions to cover at 44.80 right now. And that could change. If it changes, I'll let you know. But this is the first one we'll probably get a reaction on, 38.75. Again, about another 20% drop. And then ultimately go on and hit that longer term trend line right there. So before all said and done, if you took it on the breakdown last week and the trend lines hit, again, depending on when that's hit, you're talking about a 42% drop, give or take, maybe even come all the way down to that 29.51 level, about 48%. And that's it, unless you want this Chinese one. This one's a little riskier. YZCAY. That one has, like the rest of them, divergence. Negative divergence that's actually been building since back here. And I suspect it'll come into this trend line and or that $22 level there. All right, let me wrap it up, get the video out to you guys. We're right under the 35-minute mark, and well, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.